Military operations in the Middle East are currently escalating out of control. The primary choke point for global energy, the Strait of Hormuz, is shuttered. Before the conflict, this waterway handled 20% of the world's oil and liquefied natural gas. The market reaction to this physical constraint was immediate. Brent crude spiked 5%, breaching $106 a barrel. The fallout moved quickly into equities. The MSCI Asia-Pacific Index dropped 1.5%, erasing an entire month of gains in one session. U.S. and European equity index futures followed, falling 1% as growth expectations for the quarter were slashed. The closure of a primary transit corridor translates a regional dispute into a systemic energy shock, forcing an immediate repricing of global growth and emerging market stability. Geopolitical escalation traditionally drives capital into gold as the primary safe haven. However, technical indicators are now hitting significant overhead resistance, while macro models begin to account for the rising cost of capital. Consequently, the data is signaling a move away from gold and silver. The relationship between war and gold changes when the conflict triggers a sustained energy shock. To find the logic in this divergence, we have to map the contagion path from $106 oil to emerging market currency intervention to the technical top in gold. Isolating the mechanical transmission of a macro event is the only way to find alpha when headlines are driving the crowd. ECB President Christine Lagarde publicly challenged the narrative that the economic fallout of this conflict will be short-lived. Historical data from 2011 through 2014 shows that prolonged periods of $100 oil correspond with a steady decline for the yellow metal. High oil prices elevate inflation expectations. Consequently, bond traders pare back rate cut bets, driving 10-year Treasury yields up to 4.36%. These high yields attract global capital, positioning the U.S. dollar as the destination haven, which exerts structural downward pressure on non-yielding assets like gold. The current ceiling for gold is a function of energy-driven inflation and the resulting Treasury yields, regardless of the war's intensity. Emerging market currencies are the first to fracture under high oil prices. The Indian rupee, for instance, has weakened by more than 5% this year. Because of India's heavy dependence on fuel imports, the massive spike in crude prices directly expands their trade deficit. To stabilize the currency, the Reserve Bank of India prohibited authorized dealers from offering offshore non-deliverable derivative contracts, or NDFs. This intervention targets the long USD positions and speculative structures currently held in bank books, forcing a cleanup of those balances. This daily chart for USD INR futures shows the impact of forced liquidation, an abrupt gap down to 94.15. However, the macro trend remains in conflict with the central bank. The RSI rests at 81.13, and the MACD positive crossover indicates upward momentum remains. Structural interventions by a central bank can displace standard technical trends during a supply shock, creating significant dislocations for traders. This macro framework translates directly into technical execution on the Indian bourses. On the MCX Gold June chart, we see the initial geopolitical surge toward 15,500 before the market began to trim those gains. Given the macro ceiling, the trade setup is to sell gold at 15,200, with a target drop toward the 148,500 support zone. The MCX Silver May chart shows a similar pattern of price dislocation and a loss of momentum. The short setup for silver is at 23,500, with targets between 22,500 and 21,500. Technical indicators record these macro pressures. The initial geopolitical premium has vanished, leaving the market at the mercy of high-yield gravity. Precious metals desks earned $3.9 billion in revenue in 2025. Desk earnings came from identifying and trading localized market dislocations. Fear of import levies under the tariff agenda created a massive price premium for metal in New York over the spot trading hub in London. A subsequent supply squeeze in London created steep borrowing costs for silver, providing a windfall for banks with available physical inventory. Alpha is generated by identifying the structural spreads created when global markets fracture. We have $100 oil, weakening emerging market currencies, and technically exhausted bullion. When a geopolitical conflict solidifies into a systemic energy crisis, the entire playbook flips. Amateur traders chase the safe haven headline, while professionals analyze the treasury yields and wait for central banks to clear the speculative field.